me!
What? Big Bear chased me!
Hey, how many of you feel like John Candy from that movie, The Great Outdoors, that clip that just ran? I'd imagine a lot of you do. Let's take a look at this market. My name's Scott Dahl. You're watching my podcast, Dahl Capital Insights. Looks like the selling is continuing, and let's see if we can discern how far down it's going to go, and let's see what strategical moves that we can make that's going to improve our situation through this sell-off or this correction. What I have up now is I have a chart of the Standard & Poor's 500. And we've got a lot of data here. This is back to October of 2023. Here's 2024. You see it along the bottom. Here's 2025. And this is today's action. We're at 5,553. It's currently trading. It's Monday, March 31st. This is a correction in a cyclical bull market at this point. This is a correction. That's what this is. But this is a bearish pattern. This is a very reliable technical bearish pattern, and it's called a bear flag. Imagine you take a flag, it's got the staff, it's got the flag portion, you turn it upside down, you stick it on its head. That's what we're looking at right here. So this portion is the staff, this portion is the flag. We broke out of the bottom of this flag on Friday, and we're continuing to sell off. I can get a technical projection off this pattern of 5,036 in the S&P 500. Well, a lot of the other indices look similar to this, by the way, but that's why I'm just going to use one today. See 5,036, that's the probability of where we're headed. And it coincides with this major low right here. This is extremely important. It coincides with this trend line. This trend line is right down where this pattern projects down to. And I'm going to shrink this data so you can see this trend line. There. Now I'm all the way back to October of 2022. This is a trend line of this cyclical bull market. Cyclical means short. Secular means big. Cyclical is short-term. Secular is long-term and structural. This is a cyclical bull market. This is a correction in a cyclical bull market. If we go through this trend line and we trade below this trend line for a period of time, maybe a couple days, we are now at that point in a cyclical bear market. So we've got a long way to go before we change this trend. More than likely, this is a correction. What do we need? We need a complete washout. What I mean by that is now that we've gone so low, the absolute last investor that's going to sell, they got to sell. That'll stamp that bottom in, and then we can go ahead and go back up. Where are the support areas on the way down? Well, if you watch my previous podcast, you know they're here and they're here, right? So we could find support on the way down. I'm not saying it's got to go down here. That's just where the probabilities are. So what do? Well, the last thing you want to do is you don't want to knee-jerk out, because if you get out of this market now, you're probably going to end up being on the losing end when it recovers, obviously. So you don't want to knee-jerk out. What you do want to do is you need to examine your holdings. This is very, very important. It wasn't that important last year because all you had to do is throw a dart to make money. This year, it's a different story. I mentioned in the previous podcast that Warren Buffett, his famous quote is, you don't know who's swimming naked until the tide goes out. Well, the tide's going out. We know who's swimming naked. So in your portfolio, if you've got stocks or holdings that are deteriorating or that they're not holding up against the rest of, against the stronger stocks, you want to get out of those. You want to get out of your weak hands, your weak holdings. You want to get out of those, and you want to shift over into the strong stocks, the stocks that are showing relative strength, the stocks that are holding up in the sell-off. Because if you do that, then you've got a stronger portfolio. You've got a much better chance of catching the big move when this recovery eventually starts. So you need to make sure not only are you in the proper stocks, you want to make sure you're in the correct asset class. Do you need commodities at this point? Do you need international stocks? Do you need more U.S. stocks? You might even want to take a look and make sure that you're in the right sectors, the sectors that are holding up. So examine your portfolio. Don't ignore this. This is a time to take action. Now I have a chart up, a long-term chart of the Dow Jones Industrial Average. This is a chart from episode number 5. We are in a high inflation, high interest rate, secular bear market. Now we're going to have shorter term cyclical bulls and bears inside this longer term trend, but this is where we're at. We're in a period of rising interest rates. We're in a long-term period of rising inflation. Once you get that inflation genie out of the bottle, it's really hard to stuff it back in. So that longer term, we're going to go higher in both of those. So these are structural bear markets. These are secular bear markets. Here's where we're at right now. Look at the bottom here. Here's 1915. You run all the way through this chart. Here's 2045. Here's where we are right now, 2025. In technical analysis, there's something called the theory of alternation. And what it says is the structural market that we're in is not going to be like the previous structural market. It's going to be like the one before it. It's the theory of alternation. There's a possible fundamental reason for this, whereas we remember the mistakes of our fathers, but we don't remember the mistakes of our grandfathers. So we're apt to repeat them because we behave in a secular and a cyclical fashion. From 2000 to 2009, that's a low interest rate, low inflation, secular bear market. And this is what we have. 2000, 2009, we have a thud, we have a rally, and then we have another significant drop, and then we're in a new secular bull market. 1966 to 82 is a high inflation, high interest rate bear market. It was long, it was incredibly choppy, and it was extremely hard to make money. 1929 to 42, Depression era, low interest rates, low inflation, a secular bear market. You had a massive thud. You had a significant bounce. Then it just kind of settled on down, and then it had to get picked up again. By World War II, it ran this bull market. It started the new bull market. So high inflation, high interest rates, low, high, low. Theory of alternation. We're not like this secular bear market. We're like this one. This is a similar market to the 1966 to 1982 period. Will it be exact? Of course not, but it's going to be much similar to what we've experienced. Let's look at that 1966 to 1982 secular bear market in more detail. This is the 1966 to 1982 secular bear market. You see, if you would have bought here in 1966, it would have taken you over 20 years just to break even. And this is the kind of volatility we're going to see in between. Now, this is a very important point. There are cyclical bulls and bears inside this secular market. Here you see one here, a cyclical bear down 25%, cyclical bull up 33%, cyclical bear market down 36%, cyclical bull market up 66%. That's the kind of moves we're looking at. It's going to be really difficult. You're going to have to be able to navigate these cyclical moves in order to make any money through what is going to be a long-term, painful, high interest rate, high inflation, secular bear market. This is the last item I want to show you today. This is an Excel sheet that I built at the end of 2024. These are major brokerages, wirehouses, and banks. This is what the research department from these major companies said that we would return in 2025. This is for the S&P 500. The median of these numbers was 6,600. We are currently, as I'm speaking, right around 5,580. The average of these is 10.7%. So these research analysts, on average, say that the market's going to be up 10.7% this year. It's early in the year. It could happen, but I'm not denigrating these folks' work. But what I am going to tell you is it's fact that they have been woefully wrong for the last 2 or 3 years. So if you don't hear from your investment advisor, or if your investment advisor says, well, our research says this, ask that person what they think. It's very important right now that you're working with somebody that has experience in these type of market moves that can put you out front. I'd be happy to look at your portfolio. I'd be happy to discuss this podcast or any other podcast that I have on. I love this stuff. This is what I do. So if you want to contact me, you can reach me at phone 949-497-6366. It's Scott@DowCapitalAdvisors.com. So hang in there. Thank you for tuning in to this podcast, and I'll look forward to doing other in the future. Thank you.